This video discusses the various tools that the Fed and other central banks around the world use to guide and sometimes even jolt their economies back to health. The material here is important, especially if you manage other people's money for a living. Some of the tools discussed in the video are ongoing and behind the scenes, and you simply just don't hear about them. However, these tools are front and center in the media when the economy gets shocked, unemployment rises, and the financial markets are in turmoil. As a portfolio manager with clients or a financial manager to a business, you may be asked questions about how these tools will affect the markets, your business, and the economy. This discussion is especially relevant if you're a portfolio manager, as your clients are going to ask you your thoughts on the situation and how best to respond to minimize the damage to their portfolios. Even if you don't manage other people's money, successful people in business should be aware of monetary policy because it has a strong influence on economic growth, interest rates, inflation, and unemployment. Each of these factors have far-reaching consequences on things such as future retail sales, real estate prices, mortgage rates, the stock market, and even government programs. Okay, so let's look at an outline for the video. First, we'll cover conventional tools that the Fed uses to manage the economy. We'll look at the discount window and we'll look at reserve requirements. Absent from this video is a discussion of open market operations, which is covered in another video. These are tools created by the Federal Reserve and implemented since the Great Recession. We'll look at quantitative easing and the effects on the Fed's balance sheet and forward guidance. We'll look at loans to non-banks. We'll talk about swap credit lines with other central banks. Then we'll move on and talk about inflation targeting versus price level targeting. Okay, let's look at the first conventional monetary policy tool I had listed on the outline, the discount window. The Fed or any central bank is the lender of last resort, so it needs a prearranged mechanism or facility to directly lend to member banks quickly, especially when those banks can't get it from the Fed funds market, because other banks are nervous about lending funds in an unsecured market. The facility is called the discount window because years ago people physically went up to a window and asked clerks for funds. The money is lent overnight but can be as long as 90 days and are often renewable. So what exactly is discounted? The Fed requires collateral for these loans and discounts the collateral. That means, for example, if the collateral is worth $1 million, the Fed might lend only $950,000 against it. There are three types of loans that come out of the discount window. The first is primary credit. Those are for banks that are in good financial condition. And what's good financial condition mean? Well, they're meeting their capital requirements. There's also secondary credit, and those loans are for banks that are in financial trouble. They have low capital. They're not meeting their capital requirements. The interest rate will be a little higher on those loans. Then there's seasonal credit that goes to farms and resort areas because the banking system may be under strain at various times in resort markets on a seasonal basis. An understanding of the discount window requires an understanding of asymmetric information. Recall that asymmetric information is everywhere in the economy. It's between a bank and its loan customers, it's in the used car market, and it's even between depositors and their bank, as you and I don't really know what's going on financially within the bank between reporting dates. Asymmetric information is also between and among banks themselves. Banks don't know the financial situation of other banks at any moment in time. Banks are counterparties to various transactions, including derivatives, and banks lend to each other in the Fed funds market on an unsecured basis. Therefore, banks always want to know when another bank is in trouble, and hearing that a bank has approached the discount window is a bad sign. Just a rumor that a bank approached the discount window could cause other banks and counterparties and customers to flee, or competitors could try to steal business. Our discussion of the discount window kind of sounds like there's only one window, but in reality, there's actually 12 discount windows, one at each Federal Reserve regional bank, and each district bank sets its own rate. So when a commercial bank needs money, it goes to its Federal Reserve district bank. While each district bank sets its own rate, In reality, those rates are basically the same percent for each bank. So if you go to the Federal Reserve website and you look at the 12 district bank rates for primary credit and secondary credit, they're basically the same percentage rates. And the primary credit is set at the upper end of the Fed funds rate target, and secondary credit is 50 basis points above that. So, what kind of action has the discount window seen lately? Well, let me give you a little story. The crypto market dropped in 2022, and the repercussions worked their way through the financial system and eventually to commercial banks. Silicon Valley Bank, a commercial bank, was a pillar to the tech and crypto community. It specialized in helping these businesses financially. Silicon Valley Bank had taken large deposits, but when the crypto space started to drop, so did the issuers of crypto, and that hurt Silicon Valley Bank. Deposits began flying out the door on a wholesale level. Wholesale deposits, unlike mom and pop retail deposits, which tend not to move, are large and flighty. Those deposits can exit a bank so fast they leave a vacuum. When large deposits leave a bank, the bank needs to generate funds to pay off the deposits. Silicon Valley Bank tried to access the San Francisco discount window one day before it failed, but it had trouble evaluating its collateral. It was forced to sell assets that generated $2.2 billion in losses because it had invested its cash in long-term assets. Taking super short-term deposits and investing them in long-term assets is a classic banking mistake. In any case, the announcement by the bank of a $2.2 billion loss caused the bank run and the bank to collapse. Silicon Valley Bank wasn't the only bank caught up in this mess. Signature Bank and other banks were caught up, and the Fed ultimately had to lend $153 billion through the discount window. As an interesting side note to this story, Circle, the issuer of USD coin, was unable to access $3.3 billion on deposit at Silicon Valley Bank. This caused people to lose faith in USD coin, and for a short period, the coin became depegged from the US dollar. Yeah, this was quite ironic since from their inception, crypto and especially stable coins like USD coin were touted as safer than the US dollar, yet they pegged themselves to the US dollar and they lost value relative to the US dollar. So here you can see discount window lending over the years. Normally discount window lending is near zero, but here you can see the Great Recession spike and the gradual decline in loans that came after that. You can also see the 2020 spike due to COVID emergency lending, and you can also see the 2023 lending spike from the fallout and the impact on the entire financial system from Silicon Valley Bank and the crypto crisis. Before we end our discussion of conventional monetary policy, let's talk about reserve requirements. Central banks around the world have had reserve requirements for centuries to back up deposits. However, in more recent times, some central banks use their reserve requirements as a tool to change the money supply, interest rates, and the economy. Changing the required percentage of reserves needed to back up deposits can have a huge effect on the level of reserves in the banking system. The Fed changed reserve requirements in the Great Depression with devastating consequences and has shied away from it ever since. In 2020, however, when COVID hit, the Fed announced it was dropping reserve requirements to zero, citing ample reserves. Ample reserves is just another name for flooding the economy with cash. In effect, now all reserves are excess reserves. We will discuss what ample reserves mean in a minute. Unconventional monetary policy mostly began with the Great Recession when the conventional tools we just discussed failed or simply stopped working. For example, the Fed dropped the Fed funds rate to 0%, and it couldn't drop them any lower to spur the economy. The financial community was concerned that the Fed was out of bullets. In response, large-scale purchases were implemented as one method to deal with the situation. This happens when the central bank purchases securities with the goal of increasing reserves, increasing the money supply, and lowering interest rates. In the US, these purchases have been done periodically since the Great Recession. The Fed labeled each purchase initiative as a different QE, a different quantitative easing. In other words, we had a QE1, a QE2, and so on, meaning that we had various rounds of quantitative easing. Quantitative easing sometimes targeted specific asset purchases to ease liquidity constraints in a particular area of the yield curve or the economy. For example, the central bank might purchase only treasury bonds with 10 years or more maturities to reduce long-term rates. The central bank could also buy mortgage-backed securities to ease liquidity constraints associated with the real estate and home mortgage lending markets. There have been multiple QEs in the United States, and you can see them in action by looking at the Fed's balance sheet. Let me show you. So here we can actually see the various QEs taking place over time by looking at the Federal Reserve's balance sheet, the size of its total assets, in other words. To get some perspective, look at the bottom of the y-axis. That $1 million amount is actually in billions, so that's $1 trillion. Now, let's look at the QEs. QE1 and QE4 initially were done in haste in the height of the Great Recession and the beginning of COVID, so you see some big jolts in the Fed's balance sheet growing very quickly. QE2, QE3, and the tail of QE4 were commitments made by the Fed each month to buy X dollar amounts, X billions of dollar amounts of various types of securities by the Fed. In other words, the Fed announced it was going to buy periodically, meaning each month, X billions of dollars of certain securities. And so it executed them over a long period of time, which is why you see the ratcheting up of the Fed's balance sheet over time in those cases. Let's focus in on QE2, better known as Operation Twist. And what that means is the Fed attempted to twist or change the shape and slope of the yield curve. Let me show you. So let's examine what twisting the yield curve means. And so here I have a yield curve. I have maturity on the x-axis, where we have 1 year, very short-term interest rates, and then 30-year long-term interest rates. And so we might have 10 years around here. And so maturity is on the x-axis. On the y-axis is yield or interest rates. And so what I have here is an upward sloping yield curve, which is normally how it's presented. So typically, when the economy is growing, the yield curve is upward sloping. And it's upward sloping because investors that want to buy these securities, they realize that these securities out here are more risky than short-term securities. You can lend for 1 year. Well, you pretty much know what's going to happen over the next year. There's not much risk. It's only 1 year that you're locking your money up with. But if you buy 10, 20, or 30-year securities, there's risk. You don't know what's going to happen in the next 10, 20, or 30 years. So bond investors want a risk premium. And so that risk premium is going to be built into this yield. But that presents a slight problem for the economy in that most economists think that to expand the economy in a good way, you need to bring long-term interest rates down. Because businesses that expand, and they expand through property, plant, and equipment, tend to borrow long term. So for example, if you want to build an entire factory, you don't borrow short term, which is over here on the short end of the maturity spectrum. You don't borrow short term because you've got to constantly turn it over. As soon as it matures, you borrow again. It's a lot of risk and a lot of time and a lot of hassle and money, expense to issue that debt. So why don't you issue debt for 10, 20, or 30 years? But the problem is the interest rates are higher. And so what the Fed decided to do was to buy long-term securities, long-term bonds, 10, 20, 30 years. And so it pushed those bond prices up when it bought them. And when bond prices go up, yields fall. And so the yield curve, instead of being upward sloping, now it will still be upward sloping, but it won't slope up as much. And so yields will have come down, and that's likely, all else being equal, to spur economic activity. So one of the motivations for doing this is when you're at the zero lower bound and short-term interest rates here are close to zero, the Fed is basically out of bullets. It really can't bring the interest rate down lower than zero. It's hitting the zero lower bound. It's the floor. And so, well, they're not completely out of bullets if they target the long end of the maturity spectrum here. And so that's what twisting the yield curve means. So now let's talk about lending to non-banks. In the Great Recession of 2008-2009, the Fed started lending to large non-banks to prevent non-bank financial institutions from failing and bringing down banks. The Fed had not lent to non-banks since the 1930s. So this is considered unconventional. I remember in 2008 when the Fed announced its plans to lend to non-banks, and most of the financial community had no idea that the Fed had such authority till they blew the dust off the Emergency Relief Act of 1932. After the Great Recession and the dust settled, many people were upset by the fact that the Fed appeared to be picking and choosing which non-banks it bailed out and lent money to. So afterwards, the Dodd-Frank amended the Emergency Act so that the Fed could only lend to non-banks through programs that made credit available broadly to many businesses. And that's exactly what happened in 2020 when COVID hit. The Fed lent money to small, medium-sized businesses, municipalities, corporations, and even the commercial paper market. Another form of unconventional monetary policy is forward guidance. Forward guidance is when the Fed makes statements about the future. Making statements about the future greatly reduces uncertainty surrounding what the Fed intends to do with future policy, and it helps facilitate planning on the part of businesses and investors, which is important because when uncertainty is really high, businesses stop spending, they stop planning, and the economy shuts down. So reducing uncertainty is important. Forward guidance also provides signal about future Fed behavior and what the Fed anticipates. Sometimes the guidance is just plain obvious to people who follow the Fed. And you can get this guidance from the latest FOMC press release. For example, so here's some quotes from an FOMC press release. I'll read it and provide a little commentary. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. So it's talking, look, over the future, and in the long run, we expect 2%. The committee will continue to assess additional information and its implications for monetary policy. There you go, one of the obvious statements. Of course, it's going to continue to assess additional information and its implications. What else would it do? Then it goes on to say, in determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the Fed will continue to reduce its holdings of Treasury securities and agency debt and agency mortgage-backed securities. In other words, the Fed's going to reduce the size of its balance sheet that is ballooned up from all that quantitative easing we talked about earlier. Then it goes on and makes a quick statement about previous forward guidance it had made by saying, as described in its previous announced plans. Then it ends in the following statement. The committee is strongly committed to returning inflation to its 2% objective. There you have it, some actual forward guidance. So what's the most important part that the markets took away from that forward guidance? Well, the Fed is committed to its 2% inflation target. That's important. Actually, that's very important, which is why it's stated twice. And then the other important component of this statement is the Fed is going to reduce its balance sheet by reducing the amount of securities it's holding. So now let's move on to coordinated central bank action using currency swap lines. This is an international aspect to economic stabilization. In times of crisis, contagion is often rampant. The world's major developed countries are linked in real time through their financial markets. So when the US runs into problems, the problems are likely to show up in Europe nearly simultaneously and vice versa. Not only that, but there are billions, if not trillions, of US dollar transactions happening each day outside the US. When there is a dollar liquidity shortage in the US, there's likely a shortage in, say, Europe, for example. Foreign central banks normally hold limited amounts of US dollars in the form of foreign currency reserves to lend to their banks, who in turn lend it to multinational corporations. There are also foreign currency transactions going on in the US, and the Fed holds limited amounts of various foreign currencies as reserves to lend to these banks, which in turn can lend to multinational corporations. When a crisis hits and currency shortages appear, the Fed and other central banks coordinate currency swap lines. Stable world economy leads to a stable U.S. economy. Either central bank can take the foreign currency they obtained and auction it off. An auction provides a relatively simple method for distributing the funds to the businesses most willing to pay for it. Central banks are frequently involved in auctions, so they have the network capacity to announce and run an auction quickly. So before we go any further, let's make sure we understand how the T accounts work with a currency swap. With a currency swap between the Fed and, for example, the ECB, the European Central Bank, there's going to be a swap of dollars and euros. So the Fed is going to give dollars to the ECB, and the ECB is going to give euros to the Fed. Now, with these currency swaps, there's two legs to the transaction. The first leg is the swapping of dollars and euros, and the second leg, which is agreed upon when the first leg is executed, the second leg is the unwinding of the transaction. And it's usually unwound at the same exchange rate. So let's just use an exchange rate of 1-to-1 so it's simple. And so here's how it's going to work. The Fed is going to deposit $100 million, for example, into an account for ECB access. So the ECB is going to have access to this $100 million. And so there it is on the Fed's balance sheet. Now the ECB is going to look at that as well. That's an asset to the ECB because the ECB now has access to this money. So we're going to call that dollar reserves, actually foreign currency reserves. That's how it's labeled. We'll see that term come up later on in the course. So that's foreign currency reserves, and that'll be $100 million. And that's held at the Fed. Now let's look at the euro side of things. So on the euro side of things, the Fed is going to get euros. The Fed is now going to have euro foreign currency reserves valued. It's going to be 100 million euros because we have the same 1-to-1 exchange rate, but it has to be converted into dollars because the Fed's balance sheet's all in dollars. And so it's going to take those euros and convert them into dollars when it reports its balance sheet. But we don't have to worry about that because everything here is on a 1-to-1 exchange rate, which is not super far from where the euro exchange rate is with the dollar at any given time. By the way, the same thing applies to the ECB's balance sheet. The ECB's balance sheet's in euros. So those dollars that are held at the Fed for the ECB on the asset side of its balance sheet are going to be translated into euros. And so now what we have to do is we need a transaction over here for the ECB. And so what happens is, just like when the Fed deposited money for the ECB is going to deposit money for the Fed. That's how this side came about. And so this is going to be a deposit, and they're going to make the deposit in euros, symbol for euros, for Fed access. And so now the Fed is going to have access to euros, and the ECB has access to dollars. And when each one gets the foreign currency that it's requested, it can auction it off to the highest bidder. And so there you have it. The Fed's balance sheet grows by 100, and the ECB's balance sheet grows by $100 million. That was leg one. And leg two, like I said, is the reversal, or what is referred to as the unwinding of the swap. Basically we have nothing but negative signs, the same transactions, but with a negative sign. And it's done at the exact same exchange rate, so there's no exchange rate gain or loss. So that's how these swaps are arranged, with the same exchange rate for the first leg and the same exchange rate for the second leg. Now let's change to the last topic of this video. Inflation targeting versus price level targeting. We're not looking at a policy tool here, but an objective. Should the Fed target an inflation rate or a price level? And what are the issues? So here I have a graph of the price level on the y-axis and time on the x-axis. And I'm looking at the price level. It's got 100 here. Let's assume we start out at 100 right here. And the price level grows at 2% all the way up, basically a 2% slope. And so if we're doing inflation targeting, which by the way is what the Fed is doing now, and we assume that the target is 2%, then we're going to move along this line. Okay, that's a given. But now the question is, what happens if the Fed misses that 2% growth rate? And the growth rate drops off. So at some point in time, say here, the growth rate drops off. And the way I've depicted it here is that the price level actually fell, which means inflation was negative for a little bit at this point in time. Well, if that's the case, the Fed just continues with its 2% target growth rate, and you kind of just move on a parallel track. It's just the price level has dropped because the inflation rate went negative at this point. So if you wanted some numbers that are consistent with the graph, maybe at the time inflation went negative, the price level was at 103, the price level dropped 3% down to 100, and now we just continue at the 2% growth rate. So it has the same slope as it had before. If the Fed goes over the target at 2%, it just continues and stays on track at the 2% growth rate. We're just at a higher price level all along the way. Now let's compare this to price level targeting. So here we'll have price level targeting. And we have the same setup as before. We start off with a price level of 100, 2% growth rate or a slope in the price level. Now let's assume at a point in time, the price level drops off, right? Then we have negative inflation, basically, is what's that saying, just like in the previous graph. We have negative inflation, the price level drops off a bit. Now, if you're targeting the price level, it means you want to stay on this line. You want to stay on this line. And in order to do that, you got to catch up. And so you have to increase the inflation rate. See the slope here? The slope is increasing. That slope is not 2%. This slope is maybe 4%. You got to increase the inflation rate for a short period of time to get back on track, with the price level. And if inflation rears up and we get above the targeted price level, then the Fed is going to have to slow inflation, and you're going to have a flatter line than 2% here in order to get back on track onto this price level. Changing the inflation rate over short periods of time is really hard. So trying to get back on track by increasing or decreasing the target rate is not only very hard to do, but it's also going to confuse people in the economy because they're not going to know what to expect and when things are going to change. And nobody, by the way, really keeps track of the price level. Nobody. Let me say it again. Nobody really keeps track of the price level. What people do is they keep track of the inflation rate. They don't care where the price level is. So this is the debate that goes on in economics, but it looks like inflation targeting is the easiest to do, and it makes the most sense, and it's why the Fed and a lot of central banks have moved to inflation targeting rather than price level targeting. To provide some context to what we just looked at, inflation versus price level targeting, neither of these are monetary policy tools per se. They are objectives decided by and set by the Fed. Congress mandates that the Fed maintain maximum employment and stable prices, but does not go any further on how to do that. So the Fed decided on inflation targeting and then set the inflation target rate at 2%.